All right, everybody, it is Thursday, February 16th, right around 3 p.m. And this is a big change for my portfolio. It's something that I pretty much never do. I don't recommend doing it to everybody. I'm not a financial advisor. I'm not recommending anything to anybody, but I wouldn't even recommend this to my friends and family most of the time. People usually lose money doing this, and I'll probably lose money doing this. But I've seen some things in the market that I'm just really uncomfortable with. Meme companies, unprofitable companies with bad guidance, just rocketing 25%, 30%, upstart the other day. I just feel like there's a lot of forces in the market that are very similar to 2020, 2021 bubble type behavior, and I don't think it's warranted. I think we're in a economic environment where there's a lot of unknowns. We're seeing strong inflation data, which means that the Fed is not going to be able to lower rates, but the market was previously celebrating weaker economic data or weaker CPI and PPI, which meant that the Fed was going to either start lowering rates quicker or stop raising rates. Now that we've gotten stronger numbers, the market seems to be celebrating that we are going to avoid a recession, which is the opposite reason as why the market went up, because this would mean that the Fed would actually have to keep rates higher for longer or maybe even keep increasing them. And so with that, plus I think the market is just overvalued right now. And some of the companies I owned, I think were overvalued. I've made a lot of changes. If you want to see these things in real time as I'm making them with screenshots and text written explanations, my newsletter is the place to get it, austin.substack.com. It's in my the description below, but I'm sharing it here too. Here's the short I have, SQQQ. I have a $29,000 short right now, but it's actually in the process of adding to it right now, adding about $12,000. So it's going to be right up about $40,000, $41,000 short, right? That's a big deal. And the other thing I've done is I've actually sold Datadog, I sold Snowflake, I've sold Shopify. These companies I think were just overvalued, and I'll get into why, right? But here's an update of the portfolio. Here's a look. You're looking at all time, right? So all time, this is since February of 2022, so just over a year. We're up $14,239. We've put in $141,000, and we are now at $155,000 value. Year to date, we're having a great year, right? A lot of the stocks I owned struggled in 2022. I was dollar cost averaging as the portfolio value was lower. I invested more than I had planned to, faster than I planned to, because I thought things were, undervalued, and I was wrong at the time. But things rebounded and it has since paid off, up $40,000 year to date, up 35%. And I just think things have gotten ahead of themselves, right? And so I sold Datadog. I shared this in my email newsletter, but I sold it before earnings because I thought it was overvalued. And I'll do a little comparison using fast graphs and show you exactly why towards the end of the video. But they reported they gave weaker than expected guidance for Q1, which I think is what we're going to see from some of these companies. And the stock's down 6% today. We'll see what happens. After seeing Datadog's report, I just thought that Snowflake is trading at a premium valuation. If Datadog is struggling, then it makes sense that a company like Snowflake would struggle. And so I sold Snowflake today. It's down 4%. And look, I don't think these companies are going anywhere. I'm a big fan. I want to own these companies again. I just simply don't think they deserve the premium price to sales multiple that they're getting right now, given this environment with a lot of unknowns and slowing growth. And here's the deal. I sold Shopify a couple weeks ago, right? And now they just reported earnings and again, struggling guidance, down 14% today. Here's SQQQ. This is how I'm kind of hedging my portfolio a little bit. This is shorting the QQQ. It's very risky, very dangerous. The one thing I do like about it is I'm not outright selling a stock short, which means if it continues to go up higher and higher, you could actually owe more money than you've borrowed essentially to short the stock. And then how do you pay for that? The good thing about purchasing something like SQQQ is the most I could still lose is what I've invested. I cannot lose more than what I've invested in this, but it can get away from you and you could lose a significant chunk of money, right? And so definitely risky. You need to be aware of it. Check out the prospectus. Every ETF, every fund has a prospectus. If you're gonna do anything like this, first of all, probably don't I, again, wouldn't recommend it to my friends or myself, but if you're going to do it, you have got to check out the prospectus and the fund website. And here's just some quick background on how SQQQ works. This short ProShares ETF seeks a return that is 3x the return of its underlying benchmark, and it's 3x the inverse. So it's the inverse of QQQ. If the NASDAQ 100 goes up, this is going to go down. If the NASDAQ 100 goes down, this is going to go up, and it's going to go up 3x the amount. But it's only for a single day. Due to the compounding of daily returns, holding periods of greater than 1 day can result in returns that are significantly different than the target return, and ProShares returns over periods other than 1 day will likely differ in amount and possibly direction from the target return for the same period. So what does that mean? I'll show you exactly what that means. You cannot hold SQQQ long term, really any longer than a day is what it's designed, but I'm gonna hold it a couple days at least, because look at this. Over the last year, again, remember this goes inverse of QQQ, right? Over the last year, the QQQ is down 14% and SQQQ is down 9%. You'd think it's inverse, well, QQQ is down, SQQQ should be up because it's inverse. But because of that compounding effect and it's only meant to be held for a day, that's why over the longer term, you cannot do that. But if you look here, the QQQ, this is back in, February of 2022 through, even if you had just held on to SQQ, even though you're not supposed to, if you had held on to it from February of 22 to June of 22, SQQQ was up 71% while the QQQ was down 23%. So there were times, obviously, where people that have held it longer term still did fine, but the point is the same, right? This thing is designed for very short-term use. In general, I call myself a long-term investor, right? And I'm going to take a lot of hate on YouTube from sharing this and sharing that I'm doing this. I'm not trying to scare people out of the market. I'm not trying to move you from your strategy. I am not trying to create fear. I basically made a promise to myself to be transparent and share this journey. And what I'm sharing today is what I'm doing with my own portfolio, my own money, because I think it's the best thing to do right now for my portfolio and for essentially my family, which is why I'm doing this with managing my own money, right? People are going to disagree and it's fine. Many people who are just DCAing into index funds, VOO, that has proven to work over time through all these markets up and downs. I get it. I'm more active right now and just trying to have an amazing year in 2023, and that could be a total mistake. Most people that actively manage, lose to the market. So there's a chance that I'm going to do that. I just wanted to share this and how I'm approaching this.